Welcome to the Del Walmsley Radio Show. Listen and grow as Del questions the status quo, encourages you to think differently, and empowers you to make a better life. Get ready as Del challenges core beliefs, seeks the truth, and reveals the roadmap to the lifestyle you really want. And now your host, multi-millionaire, national award-winning investor, CEO and founder of Lifestyles Unlimited, Del Walmsley.
Welcome to Del Walmsley Radio Show, where the hype ends and the help begins. I'm your host, Del Walmsley, and as always, we're working on your financial freedom. Today, my friends, we're going to go to the mailbags, and however, I've got a little theme involved in this. It seems like I've been able to put a couple of these together that kind of match up with each other. The theme today is that, well, we almost got it right. And what do I mean by that? I mean that I've been teaching real estate investing since 1990. And during that time, I've met thousands of people. And those thousands of people have come to me with a variety of theories about how real estate works and doesn't work. Some with no idea at all, some with some slight ideas, and some with very strong opinions. And the challenge is always to try to get them to see that my approach is a stay inside the box approach. In other words, here are the parameters. Here's the types of properties we like to buy. Here's the kind of places we like to buy them in. Here's the places we don't buy them in. Here's the stuff we don't buy. Next, you got to get it for a good deal. Just buying the right stuff doesn't make the deal work. You have to buy it at a price that works. So the bottom line is that I get emails like this all the time, and I'm just going to share it with you. It says, it seems as though there are many listings that are recently rehabbed and have very little equity gain and very modest cash flow from a DSCR loan, debt coverage ratio loan, I guess. This seems like something I would be told to turn to the back of the book and to think about it. Yes, the back of the book story is when you take my class, I would tell everybody, go to the back of the book, write in there, I will not do what Del said to do, and every time you do something wrong, let's go back there, start there and figure out what you didn't listen to. It is a reflection of the current market. What am I missing? And goes on to say, I see the value in a turnkey property. The 2-day seminar teaches more of a value play, though, model of rehab and rent. At this point, my real estate investment timeline, I'm willing to be more aggressive. So what he's talking about here, folks, is that for years, people decided that just owning real estate itself was a good investment. That is as ineffective as just believing gold or silver is a good investment, or believing just dumping your money in the stock market's a good investment. Buying and holding real estate is not any better investment than any other type of commodity that you would buy and hold. Where we make our money in real estate, right, is we buy it well below what it's worth, and we capture equity up front. And then we renovate it, put it back on the market, and we rent it out for a long-term rental so that we now accumulate rental income with the tax advantages that come along with a rental property as opposed to a rehab property. When you renovate a property and turn around and sell it, you don't get any tax benefits. When you sell it, if it's within 1 year, it's short-term capital gains, it's just ordinary income. You pay full taxes on it. If, on the other hand, you hold it over a year, then it becomes long-term capital gains, and those are a little bit lower tax rate, depending on how much income you have from that particular deal. What this gentleman's talking about is that there was a genre of people out there that decided what they were going to do is go out and renovate properties and put them back on the market and sell them at market price to people that want to own rentals. So what they would do is they would call it a turnkey deal. They would go out there, buy a property, do the renovation, and make the profit from the renovation, right? And then sell the property, put a tenant in and sell the property to somebody that wanted a rental property. And they would call this a turnkey situation. You didn't have to find the property. You didn't have to locate it. You didn't have to renovate it. You didn't have to lease it. They did all that stuff for you, and you just own a piece of real estate. Well, the problem with that is you're giving away the largest part of the profit in doing a real estate deal. when we go out and buy a property, and this is interesting because I got an email, I don't know if it's even in this group, but another one I'll just mention. We go out and buy a property. It's a $200,000 property. We buy it for $100,000. And we put $50,000 in it. We own it for $150,000. It's worth $200,000. We get a hard money loan, which is 75% of the after repaired value. So the after repaired value is $200,000. And then that means we can borrow $150,000, which means we don't have to put money out of our pocket to buy the property. We do have closing costs, which may be $5,000 on the first loan for the hard money loan, and then another $5,000 to get into the second loan when we get out of the hard money loan and go to the long-term fixed rate financing. So there we are. We've made $50,000. We've got $10,000 in it. We just made a 500% return. Great deal. Great way to get rich. Now, for those of you that are very analytical, we don't have those exact same numbers on every deal we do. Some properties we buy for $125 and we put 40 in them. Some properties we buy for $150 and we put 10 in them or 20 in them. There's all different mixtures that work, but the types of properties that work are in general somewhere under $250,000 after repaired value. They're not median price, which is $350,000 and above. Those houses don't work in this kind of model. I had somebody email me the other day and said, there's no houses under $100,000 anymore. Well, of course there's not, unless you go into the slums somewhere. So that's not our model either. You can't go and look for houses that are $100,000. You have to go and look for houses that are $250,000 and or below, right? 200, 250. But then buy them for much below what they're actually worth. That's how you capture equity. The second place we make money is on rental income. And if you go back up here and you say, we've got $10,000 in it, we're making $500 a month. $500 a month times 12 is $6,000. We got $10,000 in it. We're making a 60% return on cash flow. That's not likely to be that high, but that's just an example. Let's say, for instance, we have $200 a month cash flow on $10,000. Now we make $2,400 a year on $10,000. That's a 24% rate of return. Now you can manipulate all those numbers and keep manipulating and see whatever you come to. I think that on my cash flows, I want my cash flows on single-family houses to be over 10%, because that's better than what I could get on a savings account or a CD or a money market or a bond. So I'm getting better cash flow. Now, you say, well, what about all the expenses that come with this? Well, part of our system, part of buying within the box, so to speak, is that we're buying a property and we're totally renovating it. So the roof is new or doesn't need to be replaced. There's nothing wrong that's going to go wrong with it. You've got new flooring, you've got paint, you've got new appliances and carpet. Whatever you're putting into this thing, it's going to be new or not need to be replaced because it's in pretty good shape. In that case, we have about a 5-year period of time before stuff starts to get old enough to wear out. Now, understand this. Things don't just wear out unless there's a period of time they've been used. Things, however, can be broken by tenants. So if a tenant breaks something, they owe you the money for it. Screening your tenant becomes the most important part of this process once you get to the rental part. Making sure you got tenants that will, number one, probably not break stuff, although I break stuff in my own house. I broke a light bulb the other day. It just blew my mind. I was trying to replace a light bulb, dropped it, and it blew up. So accidents happen. But I will pay for that light bulb, and if I would have dropped the glass cover that went on it and it broke, I'd have to go buy that too. If I were a tenant, I'd have to go buy that and replace that because I broke it. So if everything is brand new or new enough when you buy it that it didn't need to be replaced, if you have the best product at the best price and you put good tenants in there, you've got X number of years before things start to wear out. I say 5. Warranties, or anything from 5 to 10 years, depending on what stuff is. Like a water heater, if a brand new water heater's probably got a 10-year warranty. Air conditioner's probably got a 5-year warranty on it or whatever. And so if you put this new stuff in there, it shouldn't be wearing out. So part of our system is that you don't hold on to that particular house forever. Now, if you do, then you need to realize that as stuff would break, if you keep this house and get massive rental income on it over a long period of time, two things are going negative on you. One, stuff's getting old. Now it might start to wear out, and you're going to have to replace it again. And two, as you go down the line, you're paying down your mortgage. You have less and less of your property. You got more and more equity, which means you're making an amount of money based on a return to equity. Well, the equity is getting larger every year you pay down the mortgage. Now, you're not paying it down. The tenant's paying it down, but it is getting paid down. So you have more and more and more equity. So one of our approaches is, okay, if you're going to keep it long-term, any property, single-family, multifamily, whatever, you refinance. And when you refinance it, you go back in and act as if buying it again, replace everything that needs to be replaced, fix everything that's not working, unless there's a tenant in there, and then you wait until the tenant leaves before you renovate it again, but you keep some money aside to do that renovation again. Otherwise, you're in a situation where these things start to wear out and you start to become a slumlord. You get properties that are old and worn. You can't get good tenants anymore, and it's a spiral. It's like a toilet bowl going down a spiral that you can't stop it. The worse the tenants are, the worse they treat it. The worse they treat it, the older the property gets, the more torn up it gets, et cetera. Eventually, you, like your parents were. Most people that ever watched their family do real estate watched them do it wrong. And that's why they ended up with the problems they end up with. So I've always tried to get rid of my houses within 5 years of buying them. That way they were still in good enough shape to sell them on the open market without me needing to totally renovate the property again. So now we've got cash flow. Tax advantages. The depreciation on these things is set up such that you take the largest amount of depreciation up front and it gets smaller. We can use straight line depreciation. You can use straight line where you take the same amount every year, but I use accelerated depreciation where I take a large amount up front and it goes down after 5 years. Again, another reason to want to sell before 5 years is that depreciation goes down when you use accelerated depreciation. But that depreciation allows you to earn that income tax-free. And I say that or it's really tax deferred. But if I take that income, the next thing I can do is I can sell that property and do a 1031 and roll that money into another property. That way I don't have any capital gains, and all the depreciation I used to not pay income on the rental income rolls into the next property. So you're deferring that tax that you owe on that rental income. You're deferring the tax you owe on the capital gains. And you defer from one property to the next, to the next, to the next. Now, ultimately what happens is, if you were to keep your 1031ing and keep deferring for the rest of your life, at some point what would happen is that you would die. And when you die, all of that accumulated tax gain, taxable gain that you had there, just disappears. Your family inherits the property in what is called a stepped-up basis, which means that whatever it's worth today, I bought it for $100,000, it's now worth $300,000. That $200,000 capital gains and or the depreciation or the rental income all goes away. And they now own the $300,000 and they depreciate it too. Take a short break, be right back with the Del Walmsley Radio Show.
Teaching you with a roadmap to creating the lifestyle you really want. Keep listening. The Del Walmsley Radio Show returns in moments.
The world is changing rapidly. It's time you take action and become a part of something bigger. Learn a new roadmap. The roadmap to retirement through real estate investing. Learn from the best. Lifestyles Unlimited for the backup you need to succeed.
Having the faith to move forward, and y'all have everything provided. So if I were to ever get in trouble, I could call, a mentor and say, hey, I don't know what to do. Someone is always there to guide you. I have backup.
Lisa appreciates having Lifestyles Unlimited educators and proven mentors in her quest to retire in 5 years or less.
It's basically just having the mentors behind you.
Join Lifestyles Unlimited today for $297. That's 60% off the regular price of the Lifestyles Unlimited Financial Freedom Program. Text the word radio to 88007. That's radio to 88007. Text the word radio to 88007. That's radio to 88007. Lifestyles Unlimited. Text radio to 88007.
You're hearing the Del Walmsley Radio Show. Want more life-changing knowledge? Access our podcast and listen on demand at lifestylesunlimited.com under the radio tab. Now your host, Del Walmsley.
Welcome back to Del Walmsley Radio Show. Today we are discussing the 5 ways we make money in real estate. And there's actually 6. There's 5 for single family, and there's a different set of 5 for multifamily. So if you add them together, there's 6 altogether. So far we've discussed captured equity, making money up front, buying the property for less than what it's worth. Number 2, rental income. And number 3, tax benefits. Those are the 3 we've covered so far. The next one we're going to cover is debt reduction. It's an interesting thing. You don't even see it. It's magical. It's almost like putting money in your 401k. You don't see it happening, but your mortgage is being paid down. It's being paid down by your tenant or tenants in multifamily type of deal, and that's extra income. If you think about it, that amount of pay down, that mortgage pay down, is probably about as much as what you earn in your savings account anyway, and it happens without you even thinking about it. The other day, my wife and I were looking up a property that we've owned for about 5 years now, or will have owned for 5 years by next year. So our loan is going to come due, and we're going to refinance. And what was interesting is looking at how much our mortgage had gone down. So, we bought it, we put an amount down, we took on a loan, but the mortgage has gone down about $1.5 million. Of course, it's apartments, a big deal, but $1.5 million that we didn't even see. We didn't take it out. It wasn't part of our distributions. It's just equity gain because the mortgage got paid down. So that's another way that happens on houses. And it's amazing, especially when I had 100 houses. It was amazing how much of there was, when you had 100 different houses. It's amazing per an apartment complex. When I started buying apartments, 10 units, 20 units, 40 units, 60 units, et cetera, on all the way up to 100 units, 200 units, 300 units. The largest apartment I've ever owned, by the way, is a 320-unit apartment complex. As you see these large properties, in this particular case, like I said, we're going to have about $1.5 million already. And, by the time we refinance and so forth, there'd be a little more than that. It's really interesting to see that you make that much money doing absolutely nothing, because that's just icing on top of the cake. All right, so we've got this mortgage pay down, debt reduction. The next one is appreciation. That's another one you don't ever think of. When I first started buying houses, I was buying houses in an era in 1987 when the median price was $50,000 a house. I was buying them in foreclosure at $25,000 a house. And I did that until I couldn't buy at 25 anymore. Then I had to buy at 30. Prices went up, I had to buy at 40. Prices went up, I had to buy at 50. When prices got to 40, I decided to get out. But I had 107 houses or something like that. I watched the prices go to 50, go to 60, go to 75, almost overnight. Now remember, the prices were originally $50,000 median. But things were selling. You could buy foreclosed houses for $25,000, but it got to where you couldn't buy anything under $75,000, and new homes were $100,000. And it was like, man, that is unbelievable. How could a home cost $100,000? Well, right now that sounds pretty unbelievable that I could have believed that houses shouldn't be over $100,000. It's just incredible. But then they went from 100 to 150, from 150. Back in 2000, let's see here, when the crash, 2008, the crash, houses were at $150,000 a door. And what was interesting, when the real estate market crashed and I made all my millions in multifamily housing, and I like quadrupled my net worth during 2008, 9, and 10. During that period, single-family houses didn't go down in value. They went up, which is hard to believe. And so they went from 150 to 175 to 180 to 200. It just kept going up. The median price now is about $325,000, and I'm making that number up. It's somewhere between 320 and 340. I don't know the exact number, but my gosh, those things. My dad bought our first home we lived in for $10,000. It was a 3-bedroom, 2-bath, 1-car garage, ranch house, and $10,000. That house today is probably worth $200,000. So the appreciation is just like the stock market. When I first looked at the stock market, it was $5,000 was the Dow. Dow's now $40,000. It goes up, goes up, goes up. You don't ever realize it because it's happening around you, and you get in, when it's high and it goes higher and et cetera, then it drops and goes back and goes all around. But the bottom line is everything in our world is inflating in value. The federal government is forcing it to by creating debt, massive federal debt. That means all this stuff we have goes up. Well, why is that important? Think about it if you're a young kid or you're a Democrat. And I say that because of what I'm going to add to it. You don't own any assets. Why? Because you're told that that's a bad thing. To be somebody that has assets is a bad person. Or however else you rationalize it, that you don't have a home. You say, well, I can't afford one. I'd rather have my motorcycle, rather have my car, rather have my this, rather have my that. And you never buy a home. You rent. Or you live with your parents. Well, every year that the inflated value of life goes up 10, 15%. I saw an article the other day where they actually calculated that the actual cost of inflation is somewhere between 15 and 18% a year. All this asset value, whether it's gold, silver, houses, anything, the stock market, they're all going up. But you don't own any of that. So if you buy a house as a kid and you buy it for, right now my kid bought their first house. One of them bought a house for $65,000 and the other one paid $200,000. The $65,000 house was an old house they bought from their grandmother and got a heck of a deal on it. It was probably worth $100,000 when they bought it. Maybe they got a great deal on it. The other kid bought one that was new for $200,000. So that $200,000 house might be worth $250,000 now. That $68,000 house is probably worth $250,000. They are capturing that inflation. But if you don't own a home, or you don't own rental properties, and by the way, I'd rather you own rental properties because you get the 5 ways of making money, not just appreciation. Appreciation and inflation is something you're not going to be able to participate in. And you're going to lose out, bottom line. Your dollars in the bank are losing value. They are devaluing. So, if you don't own assets, you're not going to be a part of that massive inflational movement that the federal government is creating and will continue to create. Why? Because the federal government lives on debt. These guys, every single one of them, male and female, Democrat and Republican, they spend like drunken sailors. Now, the last thing, if you own an apartment, which is different than a single-family home, if you own an apartment, the apartment is valued by its income. So if you can increase the income, or if you can reduce the expenses, then the net operating income, the stuff that's left over, that profit from that property, from that investment, that profit dictates what it's worth. So you can literally go in, take something that's operating poorly, and make it worth more. All right, moving on. This is from a Dallas member, sent me this, and it said, I just sent out my first distribution email to my investors. And I looked at my signature line. And his signature line, I won't say his name, was CEO and principal of this realty group. And he said, it made me stop and reflect for a second. I've created my own company. And I was always scared to do so. So his whole life he wanted to create his own company. He'd never done it. And then he came here and he created his own company. Now he owns his own management company. He owns properties. He's a syndicator or a lead investor, as we call them. And he says, I just wanted to email you and reflect on how I never could have done this without Lifestyles Unlimited. Interesting point here is that he says, I know you all have seen thousands of people obtain financial freedom, but just wanted to say thank you for making it possible and showing me the way. It still kind of stuns me to see that signature line. So there you go, guys. I mean, this is massive change in people's lives. This is what we do. And your whole life, you probably never believed you could own real estate. Those of you out there that don't have any money or very small amounts of money, you probably don't believe you can own houses, that you could own rental properties, but you can if you know how to finance them, but you don't know how to do that yet. And you don't know how to qualify. You don't know how to do the things, the small changes in your life that make the big changes financially in your life. For those of you that know how to do that, but don't understand, and I've heard thousands of people tell me over the years, I never dreamed I could own an apartment complex. I thought this was big, giant companies own these things. Now we own an apartment. I never would have believed that. It just boggles my mind. I sold an apartment to a guy 27 years ago. I was talking to him the other day. He paid $1 million for that property 27 years ago. He and his wife they retired, and they lived off this property for 27 years off the cash flow. Then they bought a 40 unit also. They had another 40. But I asked him, he's getting ready to sell this thing. And I said, what's it worth now? He says, it's worth $7 million. He bought it for $1 million. He lived off of it in retirement for 27 years, and it's worth $7 million. My friends, this stuff is unbelievable. And I truly mean unbelievable. You hear it, and you can't believe it. That makes it unbelievable. The only thing I can say, come check us out and find out that it's real. Have a great day. And remember, it's not the money, it's the lifestyle.
The information and opinions you hear on the Del Walmsley Radio Show are those of the host, Del Walmsley, his guests, and his callers. The Del Walmsley Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Del Walmsley Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.